Hey, good morning. Welcome to this Wednesday, August 16th, 2023 edition of Trading Places Live with at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes or so as we check out what's happening in the market and see maybe what we can expect today. We continue to drift lower. The major indices that we look at continue to be tested. We've seen some breaks of the 50-day moving average, which in the short term clearly is not bullish, that's bearish. But we haven't lost major support. And the key to me longer term is the 20-week EMA to the upside. We have a very, very strong PPO on weekly charts. And as a result, we can get 20-week tests at any time. We've seen that plenty of times in secular bull market advances. But the question is, do we hold? We haven't tested those yet. We still have a little bit of room to the downside there. And for those who are wondering, okay, what will it take for you to get out of the market? A close below those 20-week EMAs, and I will be sitting on my hands waiting to make sure that we come back up above those. I'm not seeing any signals. I have a lot of my own signals, proprietary signals. And I'm really not seeing anything that suggests that this is going to last. So, and it was something we talked about a month or so ago. If you wanted to go back and take a look, you can pull up my YouTube video. It was a Your Daily 5 that I did. I think it was back on July 19th. And I talked about reasons why I was very cautious. And I think the title may have said something about being bearish. I was not bearish. I was just cautious. Whenever the risks start to increase, you have to take either precaution or at least be aware that we could be looking at some additional selling and perhaps even some moves, significant moves compared to what we have seen in 2023. There was the potential for a significant move to the downside, potentially. And again, this for me is a worst case scenario down to those rising 20-week EMAs. And so nothing really has changed there for me. It's really difficult when you see these signs come up. I don't have signs that say the stock market's going to drop 3% or the stock market's going to drop 6% or we're going to get a 20-day test or we're going to get a 20-week test. All my signals tell me is to be careful that, and whatever that means to each individual, it could be that, hey, you're in the market. You don't want to be in the market. If it's cautious, you just want to kind of step to the sidelines. That could be your choice. It could be, hey, I got a bunch of stocks. I'm going to sell calls against these stocks. Just in case the market starts to go down, you pocket the call premium and, you continue to hold your stock. So that just buffers a little bit of downside action. For those who are more aggressive, you could short. I don't personally short secular bull markets. And I believe we're in one. I think we are continuing the one that we started back in April of 2013. And I don't short once we start, moving back up into a secular bull market advance. Shorting's off the table for me. But for those who are aggressive and you see these warning signs as an opportunity maybe to switch from long to short, completely up to you. But obviously the choices are yours and that risk is yours as well. You just have to decide what these signals and caution, what this caution means for you. Quite honestly, I was expecting a move maybe down to the 20-day moving average, which we've seen and gone past on all the major indices. There's some support areas that I've been pointing out, the IWM in particular, right around that 188 level. We closed yesterday, I think, at 188.14 or 188.16. Actually, I can look at it at 188.14. So we are right at about where we had the double top breakout back at the beginning or second week of July. So again, these pullbacks are really difficult to say how much they're going to pull back or even if they're going to pull back. When I see cautious signs, it maybe tells me what it tells me is I don't want to be in the leveraged ETFs at that particular time. But if I'm bullish and I'm getting a pullback, I could use that pullback to start building leveraged ETFs. So that's kind of where I've been over the last few weeks is as we've pulled back, I've been building taking a little bit out of something like the IWM and moving it into the TNA, which is a triple leverage, which right now I'm down on it, but that was what I planned to do as the market was pulling back. And depending on how far it pulled back, it was going to depend on how much of the money was transferred from the IWM to the TNA. And I want to be clear that I own both. What I want to be long because I believe we're in a secular bull market advance. And what happens, let's say we get up to the top, even back on July 19th, and the market doesn't pull back, even though I have all these signals that say, hey, we need to be cautious. What if the market just keeps going up? And let's say I get out of, move into cash, or worse yet, I start shorting the IWM through one of the leveraged ETFs or whatever. What happens if the market keeps going up? I'm very bullish long term. So now the market's doing exactly what I think it's going to do long term, and I'm losing money because I'm in the short position. That for me is the worst situation. So I try to avoid it. And I'm saying this because we've had a couple questions come in, particularly from members, asking for me to clarify my position on the market. I don't know that I can be any clearer. I'm bullish long term. Bullish. Not partially bullish, cautiously bullish. I am bullish. I think in the fourth quarter, we're going to be setting all-time highs. We'll see. Maybe it goes in the first part of the year, but I think fourth quarter is going to be very strong. So I just think August and September is a bridge, and I don't know exactly what this bridge is going to look like. Maybe we're all going to get scared. Maybe market's going to pull back further than we think. I still don't think so. I believe the rising 20-week EMAs hold on the major indices, but we'll see how this shakes out. What I talked about a month ago was very short-term in nature. When I'm talking about potential selling, it is really just about the short term, and just signals are suggesting, hey, we had momentum issues. We had negative divergences. We had the volatility index and the S&P 500 both going up simultaneously, which as the market goes up, when the fear starts to pick up, I can show you past history. We need to be careful. When that correlation between the VIX and the S&P 500 turns positive, that's usually the sign of a potential reversal. And it worked.
Tom.
Yeah.
Are you meant to be sharing screen right now?
No, I haven't started to share. I'm just talking to everybody.
Okay.
We'll get into the what happened yesterday in just a minute. But I've gotten some questions, and I just want to make sure. I don't want to cloud it with charts. I don't want to cloud it with anything. I just want to say where I stand at this point. So I am clearly bullish. Now, again, does that mean I'm going to just blindly follow leveraged ETFs and just hold them long term? No, I know that doesn't work. Over time, you lose, you have erosion, and it's very, very, the odds are very slim that if you hold a leveraged ETF, a 3 times leveraged ETF, let's say for a year, the odds are very slim that at the end of a year, your 3 times ETF is going to outperform the regular ETF by 3 times. It's going to be something less than that because you have this erosion. So I try to pick my spots on pullbacks to get into those leveraged ETFs. If they don't work, we're still, as far as I'm concerned, in a secular bull market. I just don't want to hold the leverage anymore. So we're very close on the IWM. I've told members 188 is, we close below 188 and I'll be out of the TNA. Doesn't mean I'm going to be out of the market. I will be out of the TNA, most likely just back into the IWM. I just don't want to leverage, but I also don't want to be out of the market. Now, everybody else is different. This is a key support level. Some of you might be, hey, if we lose support, I'm getting out. Fine. I can't tell you where the market's going to go over the next few days to few weeks. I can tell you what I think is going to happen, but I don't know. I don't have a crystal ball. Longer term, I feel better about calling the market. Short term, it's dicey. And sometimes, I get some criticism that, hey, you're saying you're bullish, but then you're bearish or you're cautious. It's what I am. Sometimes we're going up, we're at highs, and the market looks beautiful. And I see no reason to change any of my strategies. Other times we're going up, we start seeing warning signs ahead of time. And that's what I tend to react to. And so hopefully this clears up for those of you maybe that were on the fence or really didn't understand where I was sitting. Just wanted to make sure you understand. Short term, I think we have issues that we've had since July 19th. Again, go to the YouTube video I did on July 19th. Search my name with your daily 5. And you should see one that comes up, something about Tom is bearish with a question mark. Go back and look at that video. It was right at the top, talked about the things that we needed to be worried about. And a lot of it has played out almost perfectly as the market's pulled back. Anyway, let's take a look at what happened yesterday. All right. Yesterday, we saw the Dow Jones Industrial Average fall 361 points. S&P 500 down 52. NASDAQ 100 down 168. All three indexes down just slightly more than 1%. So they're all just kind of going down in similar fashion. Mid caps down 36 points. That was actually a little bit more, down 1.35%. And the IWM small caps down 1.32%. That was $2.50. Back down below the 190 level, below gap support, below the 50-day, and right about and slightly below the breakout level. You know, I was giving it a little bit of room down to 188. I think the high may have been like 188.30 or 188.32, something like that, on this double top. And so that's where we broke out. Yesterday, we actually came back down and tested it. Day before, we had a nice hammer in. It looked good. We didn't get all the way back down to that double top, but we got pretty close. Had a nice reversing candle, nice hammer. I thought that was it. And yet yesterday we went down again. You know, market does what it does. Transports. Yesterday also looked like it had printed, or the day before yesterday looked like it had printed a really nice hammer on the 20-day moving average. Yesterday that was gone, eliminated. Forget about that hammer at this point. We have now traded back down and closed below the 20-day. And with a slight negative divergence on the transports, wouldn't be surprised to see a 50-day test. I mean, that's what we've seen on all of our other major indices with negative divergences printing. From a sector perspective, energy down 2%, a little over 2%. Financials down 1.8%. Materials down 1.6%. Those were your three laggards yesterday. Notice there's no technology. There's no consumer discretionary. There's no communication services. Those groups already had pulled back, and we're starting to see, at least here recently, starting to see a little bit more rotation back into those groups. Will it mean anything? I don't know. Just telling you, that's what I'm seeing. Aluminum index down 4.37%, the worst performing. Actually, renewable energy was the worst performing group yesterday. I don't have it on here because I wanted to show you the industry groups that were impacting the sectors to the downside. But renewable energy actually dropped, I think, a little more than 5%, mostly because of First Solar, which was down about 5%. Anyway, aluminum index down 4.4%, non-ferrous metals down 3.3%, and then integrated oil and gas down a little more than 3%. So energy and materials really took a tumble yesterday. Notice aluminum breaking to a new 2023 low. That was significant. We had gone down. We were in like a little bit of a symmetrical triangle, maybe, which normally you break in the direction of your prior trend. It's exactly what happened yesterday with aluminum. Trending down. There's your lower highs. Here's your higher lows. And here is the breakdown over the last couple of days, and now confirming it with a new 2023 low. Non-ferrous metals breaking down below both the 20 and the 50-day moving average to about maybe a 6-week low. And then integrated oil and gas, which was really looking strong. And this kind of underscores why you don't hear me talk a lot about trading energy and materials, especially energy. Energy for me, for whatever reason, I think there's just too many variables with the price of crude oil and the impact that it has on the stock market and many of the energy industry groups, and of course in the energy sector. But I mean, look at all these tops that we saw on integrated oil and gas coming across here at about the 750 level over 3 months. And then we finally break out. You got to believe, hey, this is it. And maybe we'll move back up off today. Yesterday was a pretty rough day. went back down just below that 750 level. It really needs to pop here back to the upside, or it's just going to be another false breakout. I see these, it seems like, within the energy area more than I see them in just about any other area in the market. So it was not a good day. In fact, all the sectors were lower yesterday. Most industry groups were lower. Most of it, or some of it anyway, came at the opening gap. We saw gap downs, but we did see distribution a little bit yesterday. That's something we really haven't seen much. We've seen the AD lines continuing to move higher. You can see the Dow near its 52-week high. S&P and the NASDAQ both have pulled back a little bit with their sell-offs. Mid caps keep going higher. Look at this price action down and the AD line going up. Look at the small caps. Been straight down now for about 3 weeks. And the AD line just recently set a new 52-week high, continuing to move higher. So that's telling me, or at least it's giving me a signal that this is not just all out selling and distribution. Just like 2022, I talked about it with the QQQ all year, pretty much, especially right toward the end of what I thought was the end of the cyclical bear market in mid-June. We ended up going down one more time. But that AD line was one of the signals that remained strong throughout that sell-off. And we're seeing the same thing now with the Russell 2000. I mean, that's a pretty big decline, pretty steady decline for the AD line just to keep going higher. Why? Because a lot of it, I think I looked yesterday, and I believe from the high, the IWM had gone down something like $10, and I think the net gaps during this period have been $7. So in other words, the selling, 70% of the selling has come at the opening bell. I mean, that's not the way Wall Street gets out of stocks. They don't put market orders in for millions of shares at the opening bell. If you ever watched the market action at the opening bell, the first 5 or 10 minutes, you've got wide bids and asks. It's not very liquid. Market makers are using it, in my opinion, to accumulate shares. And a lot of times when you get these gap downs and then you see buying throughout the rest of the day, to me, that's a bullish signal, even if you finish down for the day, because there was buying most of the day. And that's mostly what we've seen during this last 2 to 3 week period on the IWM. Anyway, let's keep moving. 10-year Treasury yield. Let's get an update here. Economic report out this morning. We had July housing starts come out. And for the second straight day, we've had some not so great news in housing. July housing starts today just slightly below expectations, 1,452,000 units versus the estimate of 1,455,000 units. But the July building permits came in 1,442,000 units versus the estimate of 1,464,000. So we've seen, and yesterday I think was the market housing starts, or housing market starts, or housing. It was the heck was it? I'll tell you what it was. Housing market index. All right, no starts. Housing market index, which, by the way, was expected to come in. This was at 10 o'clock yesterday morning. It was expected to come in at 56. The prior month was 56. It came in at 50. Very, very big disappointment on the housing market index. And most of the housing stocks yesterday were up. We had some pretty good reports out of, I think it might have been D.R. Horton, or maybe just an announcement. Let me see what that. Yeah, there was the move up in D.R. Horton yesterday. And if we pull up the home building, you can see moving back up near the recent highs. But the bad news is starting to pick up a little bit in the housing. We do have maybe a slight negative divergence from that July high right there, slightly lower. And we've seen our PPO working its way back to the center line. And sometimes what I've said is when we get negative divergences, you can either sell off down to the 50. We see that a lot of times, or you can go sideways consolidation while the 50 continues to rise. And eventually you get your test that way. This is a perfect example of that latter, where you just go sideways. We haven't really seen much selling in the home construction, home building area, but we're working off this negative divergence, and the PPO is getting very close to a zero, center line reset. And we're still trading up near the high. But again, it's the sideways consolidation that's working off those momentum issues. All right, let's go back to the 10-year Treasury yield. So we're getting very close to that 4.33% yield. That was the top we saw in October of 2022. And now this morning we're at 422.5. Yesterday we hit 427. So we're getting really close. We don't have another Fed meeting. I think I may have said earlier this month or maybe last month that we had one in August. We don't have our next one until September. So I have a feeling, and this is just a feeling, but I have a feeling by the time the Fed meets in September, I think basically they're going to give the all clear signal. Or maybe the Fed isn't going to give an all clear, but I think the language is really going to start to change in terms of they're going to continue to watch inflation, but they think they've had, success bringing inflation back down. We'll have another month of CPI and PPI reports coming out, and that's going to be almost perfect timing. I think it's around the 19th, 20th of September, but that's getting close to the end of the third quarter and the pre-earnings run that starts usually at the end of September. So I think what we've got now is maybe another 4 to 5 weeks of either maybe we continue a sell-off here in the near term, but I suspect it's going to be a little bit of buying, moving back up, a little bit of selling back down. I expect some consolidation here through maybe that Fed meeting. And then maybe even with the Fed meeting, sometimes we get these head fakes. Maybe we pull back, but then I think we're going to rise. I think we're going to rise rapidly in the fourth quarter. I don't know what's going to happen to the interest rates because I just think, when we went from 3 or 4% down to zero, it was because of the pandemic. And now we've gone from zero back up above 4. And I think a lot of it is just normalization, getting back to what we used to look at as normal. 4% 10-year Treasury yield is not high. That is still historically a really good interest rate. I know it seems high because we've been seeing the Fed hiking, month after month, and we've seen the yield go up considerably in a fairly short period of time. But we saw the same thing on the opposite side. And I think with the cyclical bear market in 2022, I think a lot of that's been wrung out of the market. So I think we're normalizing. I've even said potentially we could break out. Yesterday's show, I mentioned that the 10-year Treasury yield's right back up where we were in October, but the stock market's nowhere near where it was back in October. We're up 1,000 points on the S&P 500. So the market is, I think, recognizing the stock market, that we're just moving back to normal. And I'm not quite sure where that normal is, but I'm guessing it'll probably be in the 3 to 4%. At one point, I thought maybe we'd go back to 2.5. I don't know that we go back down that far, but maybe we get back down in the 3s, maybe even 3.5. I wouldn't be surprised maybe to test these other lows down here at some point down the road, but I don't think we're going to see 1%, 2% like we had seen with the pandemic. All right, quickly, actually, what I'm going to do is I'm not going to go over the major indices because the chart of the day, I'll show you a different approach, looking at it on a 60-minute basis, all the major indices. But let's first take a look over at earnings beats. And if you go to our homepage, earningsbeats.com, and you scroll down, we have a free newsletter. If you like the chart of the day, type in your name, email address, hit that subscribe button. No credit card required. You can unsubscribe at any time. It's completely free. It's just set up really just to provide some education. Things, the way I look at the market, things that are important to us at Earnings Beats, that's really the goal of it. So be sure to check that out. Also, we've got a live trading room coming up here starting at 10 a.m. Eastern, just a little bit more than 30 minutes from now. And the market getting ready to open in about 5 minutes. But you can click here for room instructions for members, And you can sign up and become a 30-day trial member. And if you sign up today, you'll get 5 weeks, 5 Wednesdays of this live trading room. I think you'll get a really good sense of how we look at the market, how we try to manage risk, and how we look at the big picture in the market to try to, work our way down to what makes sense as an individual trade. And it might be individual stocks, it might be ETFs, whatever it is. We'll be looking at it at 10 a.m. this morning. So be sure to check that out. Also, if you're watching this, by the way, and live streaming, be sure to hit that like button and subscribe to our channel. We do these events from time to time. And if you're subscribed and you turn your notifications on, if we go live and do an event that's free and to the public, you'll be notified. So make sure you do those. We'd love to have you. It helps us as well. So please hit that like button and subscribe. All right, here's the chart I wanted to show you. This is what we sent out as part of our EB Digest this morning. I may have had different support levels because I had to recreate the chart in this particular stock charts account, but it was something similar to this, where over the course of the last 2 to 3 weeks, we have been within channels, down channels, moving lower, but we've now reached some key support levels, mostly the double top breakout that we saw back in the second week of July. Our indices now, for the most part, are back down or somewhere near those levels. S&P trending lower, back down to this double top breakout gap support. We finished almost right at the gap support level yesterday. The Dow Jones, the strongest, by the way, on a relative basis, because we broke out above these tops in mid-July, and we have not worked our way all the way back down there. We had this one little head fake, but if you kind of chop that off, we connect these tops and bottoms almost perfectly. And we're right in the middle of this range right now to the downside. You go to the NASDAQ 100, again, almost a perfect channel off of the recent high. And one other thing, you could look at, let me annotate this. Because the other thing here that I see is the possibility of, just kind of draw the line there and then kind of draw the line here. But it looks like a bullish wedge. And so off of this recent uptrend, the highs, if you connect them, and the lows, if you connect them, are squeezing into a pie. That's a wedge. And a breakout of this, a lot of times, is the signal of a continuation of the prior trend. So we're kind of looking at that right now. Let me get back out of here. So any kind of a breakout above these channels, especially if we can get them all four simultaneously, that would be pretty bullish in the near term. And that might suggest, I don't think we go to all-time highs because, again, I think we still have to deal with the rest of August and September, but it could just be a small rebound. And then maybe we come back down, test again one more time in September, and then hopefully ready to go in Q4. But every one of these, here's the IWM. Here was the double top, which is pretty clear, right about that 188 level, just above 188. And we came down and we closed just below these tops. Now, remember, many of these tops are intraday, not closing. The closing resistance, like I said, was like 188.20 and 188.30, something. It might have been 188.10 and 188.30 on the double tops, or the double top that we had back in June and early July. But we're back down right to that level now. So this is an area we really need to watch. The thing is with the IWM is if it breaks the 188 level, I don't really see any support here on the hourly chart until we get down to 180. Now, that doesn't mean we go to 180, but that's the next support level I see. The other thing that I would mention here is if we pull up the S&P, I showed you price support on that 60-minute chart. Here's the weekly charts. Now, when you look at these secular bull market advances, you can see we occasionally go down and hit this 20-week, maybe even slightly below intra-week, and then come back up. That's been the pattern. I mean, we could go back 10 years. And when you're looking at these bull market advances, the 20-period moving average tends to be very strong unless you start getting negative divergences. Then maybe you go to the 50. But for the most part, when you're looking strong, these 20-period tests are normally where you find excellent support. So we're still well above the 20-week moving average. That to me is what I'm talking about, is a line in the sand. Remember also, the August high was 4,300 on the S&P 500 that we took out. So from a more intermediate to longer term perspective, 4,300 was a major resistance level. It becomes a pretty important support level as well. So you take that 4,300 along with the 20-week moving average at 4,338, and that kind of sets a really important intermediate to longer term support area. And so that's why, to me, that is my line in the sand. As far as sticking with this uptrend, if we go down and we have weekly closes below there, I'm going to need to see us get back up above the 20-week before I'm going to be back on that, full 100% invested kind of a thing. So anyway, that's the S&P. I'm going to pull up the IWM because that's one of the, obviously we've been looking at and trading. The 20-week EMA is at 185.89, 186. So some of you might say, well, if we break 188, I'm okay with 186. The problem, obviously, is that I liked it at the 20-day. It broke. There was gap support at 189.20, I think. That broke. Price support now, 188.30. That broke, even though it was just barely, but that broke. And now we're talking about this 20-week. All of those levels potentially could come into play based on what we saw back in July. Obviously, worst case scenario, in my opinion, was going back down to that 20-week moving average. We're not far on the IWM. So we'll see what happens, but I fully expect that this triple top, we are going to break back out above it. Is it going to happen in August and September? I don't know. But I think by the fourth quarter, we will be in the 200s on the IWM. That's my feeling, my opinion. All right, it is 9:33. Let me just show you. I'm going to show you two charts that I showed back on July 19th in that video, the YouTube Your Daily 5 video. Go back and search it and look at it. And I had a couple comments. I mean, I'm not even responding to some people on YouTube. Had a couple say, or one in particular said, this was such a wrong prediction or something. I'm like, I don't even know what to say to that. I mean, it pretty much has panned out perfectly. But anyway, the S&P 500, if you look at the correlation between the S&P 500 and the VIX, we saw it back at the beginning of January. I got really bullish. I wrote very bullish article in my Trading Places blog at Stock Charts. I also did a video, I think it was on January 5th or 6th. I said, we're about to explode to the upside. And this was one of the reasons. The S&P 500 was going down and the VIX was going down with it. And as a result, we started to see this positive correlation. And when we see this, I look for a reversal in the market. I think the VIX is giving us a signal. And so the VIX was starting to get more and more complacent as the market was going down, which is unusual. It's like market makers, which I think influence the VIX much more than, say, the equity only put call ratio. To me, this is like sentiment from a market maker perspective. And there was no additional premiums going into the options. That's why the VIX was coming down. So market makers are basically saying, well, the market's going down, but we're not going to ask anybody to pay us anything more for options. That almost never happens. So what happened? We had one of the best Januaries on record. Now, recently, right back down, when I talked back on July 19th, we had just set this positive correlation. We went into positive territory. Notice we stay down near -1 almost all the time. So it's kind of a big deal when this turns positive. Anyway, we turned positive. What was happening with the S&P? It was going up. Well, the VIX started to go up with it here. And as a result, I mean, we were coming off of these lows. This low was, we were kind of near a low right here when we were at a high. But over the course of the next couple weeks, the VIX was starting, here it put in a bottom. So over these 10 days or so, we were starting to go up as we were going up on the S&P and setting new highs. Now, we did actually go a little bit higher. And if you look at history, this has happened before. This isn't always a perfect indicator, but it's just kind of giving you a signal like, hey, the market's going up, but the VIX is showing that we're getting a little bit more fearful. And that just suggests that it's not going to handle bad news very well. And if we start to sell off, it could escalate. And that's what we've seen. So now look at where we are on the correlation. We're back down to -1. Why? Because as the market's gone down, we've seen the VIX go back up again. So they're going in opposite directions. One's up, one's down, and there you have it. The other thing I talked about, look at the reading on the 5-day moving average of the put-call ratio. Now, I didn't go in and mark these, but if you look at every one of these significant bottoms, essentially the S&P 500 topped. Here, look at this. That bottom right there, perfect top. We went down for 6 weeks after that. Now, it could just be we go down for a few days to a week. Doesn't mean it's going to be long-term. Here, we bottomed, and here we went down very briefly. Over here, actually, we went down a little bit. Didn't really work very well. This one went down for maybe 2 weeks. This one continued our decline to the end of that cyclical bear market. Well, tops, if you look at a top here, that one so-so. Here, this top was almost perfect with the market going back up. This top, perfect with the market going back up. This top, ignore it. We had a lot of equity puts being bought by hedge funds, which was very unusual. I've talked about that a lot. I'm not going to spend any more time on it here. But just about every one of these tops, you'll see bottom. Here's a top. Here's a bottom. Here's a top. There's a bottom. Here's a top. There's a bottom. Well, we're rising. And notice all of these came in at anywhere from about 0.75 to maybe about 0.80, maybe even 0.85. We're almost to 0.75. We're getting close. The equity-only put-call ratio is telling us we're about to make a bounce, possibly a big bounce. This could be the bottom. We could see the market go back up. It's happened in August and September before. We'll see. But just want to make you aware that we're completely different now than where we were. And again, some questions came up about that, and I wanted to hit that. All right, let's take a look at what's going on in the market. See if we're going down, if we're bouncing. Kind of mixed bag. Dow is up 140, so that's nice. S&P 500 up 7. NASDAQ down 27, so a little bifurcated action today. Small caps, mid caps, both showing some strength so far this morning. And the VIX back down to around 16. That 16, 17 level is kind of important. If we go through that and the market does lose support, I could easily see the VIX getting up to 20. That would probably maybe coincide with 20-week EMA test. But again, I don't know in the short term whether we're going to go down to those 20-week EMAs. Have no idea. I just pointed out because, those are areas that the market has gravitated in the past when you're in a secular bull market. We can go down and test those 20-week EMAs, and we're not there yet. So we'll see what happens. Anyway, that's it for me. We are going to be having our live trading room in 20 minutes. So you got time, go over to earningsbeats.com. Make sure you get signed up for a free 30-day trial and come in and join me here in about 20 minutes. Have a great day, everybody. Happy trading.